Welcome to Cycles TV. This session of the Market Cycles Report is intended exclusively to provide information and education to help individuals better understand cycles and the markets. However, this information is not to be
Welcome to Cycles TV. Oh man, I'm late today. We have the daylight savings time switch, so I need to excuse for the timing hiccup. But at least welcome to another episode of Cycles TV. My name is Lars Fontin and welcome to Monday's episode. Today I have a special look at the current situation. Let's look into the banking sector and let's check what the cycle analysis can give us for clues on using cycles in the banking sector. So I will not comment on the current activities and the news, what's happening there, but let's use the cycles to see how they could guide us through the current situation. So that's the topic of this special episode. It's a little bit chaotic during the last weeks for me, so but I'm here again. I'm live today, so let's jump into the purpose of today's session. Banking sector, cycles. I mean, what's happening out there? Before I'm jumping into this topic, let's quickly review. 2 weeks ago, we had a session on the the volatility index cycles. So just a quick recap before we switch over to the banking sector. This is just the extract here from the session we did here end of February. Yeah, you see it here on the screen. And I talked about that this is a great place for the volatility index to bottom. I think we have seen it at around 2021 at that point in time. And if we look at today's volatility cycle, where is it trading right now? Today's volatility cycle is at 28, and the peak is even above 30. Yeah? So you see how nicely the session was on the 27th, and the cycle showed us, just switching back here, to bottom at beginning of March and then moving up, which is what we couldn't have been a better match of cycles. Yeah, so that's the beauty of cycle analysis. And by the way, this is a sentiment measurement. This is what we showed you here live on the channel 2 weeks ago for the volatility index to make a bottom here. And shooting up from 20 to 30 is a 50% move in the volatility index. We showed it to you ahead of time. Yeah, right? Okay, but that's for the volatility index. It gives you a clue on the current sentiment, which I reviewed in that session. It's still valid. But that said, as we have now unfolding different cycles within cycles, so from mid-March, and I think that's what I often referred also in that session here, from mid-March, which is now, a lot of cycles are rolling over to their downward phases in different data sets, the volatility index, the financial stress index, the S&P daily cycles, the S&P weekly cycle is still moving downward, the Apple tech sector cycles, all these 5 data set I've just numbered, all these cycles are pointing to a downwards phase. Daily cycles, I mean, intraday we can see large swings, but this is the situation from March into October, this period. You saw it on the volatility index, how nicely this happened now. And we see the first impact of such a big cycle. All cycles turning down. So now it looks like the banking sector is one of the first specific sectors which is impacted by all these cycles rolling over to the downward phase. Yeah, you will not see it in the S&P just across all sectors. The banking sector is now the first where we see the impact of cycles within cycles, within cycles, within sentiment, within volatility, within data sets rolling over. And that's why even let's now dig into the banking sector in specific. Okay, that's just the intro. I've prepared a little bit the banking charts here, but let me first pick the right one to start with here. So let me clean up the screen. So therefore, we will switch to our cycle analysis application. By the way, what I'm using here just for today's analysis is the NASDAQ Regional Banking Index. Yeah, so I'm just using the Regional Banking Index, which is a broader index listed here, so you can review the prices. It's an index series which goes back some years here. And I mean, we all know what happened here last week with this data set due to the news we had on the Silicon Valley Bank, but it's just the first one here right now. So using this data set now for our analysis, let's see if cycles could have guided us through what happened here. In specific to the general market outlook, I've shown you on this channel here, and now specific, let's dig down into the banking sector. Okay, using this data set, I've just uploaded this data set into our cycle scanner, yeah, which everyone out there can do. It's not easy to find it in specific, but it's just to click to upload this data set to your specific analyzer, and then you have it in your data set. So the first analysis or the first discussion I want to do with you together here is the situation: would the cycle analyzer have been able to show us this breakdown here, or this crash or whatever, in advance? So this is why I selected the starting point here at the beginning of February, and the light blue is here now the out of sample data. So this what happened here afterwards is not known by the cycle analysis framework. And I'm just using the standard setup here, which is selected when you just open the data set. So this would have been the situation on the 2nd of February, opening our cycle analyzer, using the regional banking index and pulling up the cycles here. You see that from the historical analysis, I'm using 850 bars here, which is the standard setting. If you don't change any parameters here in the cycle analyzer on your own, this is the same as everyone would have seen and started with. So I will now just remove the light blue data just from a visual perspective. This is how the chart would have looked like at this point in time. Now looking into the cycle scanner here at the bottom, you see might not be the easiest way to pick the right cycle. There are different options now we could use. So first, we could pick this cycle here with a length of 274 days. There are some reasons to pick. One reason is we have a very high Bartels score. We have a good cycle strength. However, the visual shape of this cycle is not perfect. Yeah, so a perfect cycle would mean we wanted to see the right hand side of this peak in the spectrum to move down even more. So one of our criteria is not the best. However, the other two criteria are a green triangle, a large triangle, and a high amplitude is met in the spectrum. Not perfect, but okay. The second one we could use then is this cycle here with a length of 182 days, which is it's blue, so not the best from the Bartels score. The strength is similar, good to this one here, and then the separation to the left-hand side not perfect, so also it's okay, not perfect here. And then if we would have to choose shorter cycles here, it's then maybe just the one here with the length of 65 trading days, which is good because it has the highest strength. Yeah, so the largest triangle is on the top of the list. However, the Bartels score is quite low. So we would have 3 cycles to go based on our standard criteria to pick. It's not a perfect composite we would build out of that, but let's now activate these cycles here first. Let's start with the longest one. which is the cycle of 274 days, yeah, which is this one here, which gives us a nice peak exactly at beginning of March. So, and this cycle would have indicated us, just from looking at past data, it's very good in alignment with the past swings of the banking index here. So has indicating us following top here, which by the way is that exactly what happened. So just using this longer cycle would have been one clue to do this. So now adding the second cycle into the mix here, this would extend a little bit the top to the right, but the general outlook is more or less the same. So expecting a major top here and then down into late summer this year. And then also adding the shortest one here, 65 days, is giving us this picture here. You see now, if we add these 3 cycles, you get a very nice fit here to past market behavior. Yeah, if we just scroll it here, but that's always the case. The more cycles you add, the more it fits to the past. But the general outlook here is the same. So we see one top and another top here. So in general, this top here is quite perfect. It's now interesting to follow up what's happening here during summer, but at least the main projection is, at least from this data set, topping here down into late 2023. As I said, not quite perfect. So it would have not been easy from these 3 cycles, which would be possible candidates. You see a top here, yes, but also a second top here. The most perfect cycle would have been this longest one here, which I've outlined here, which is more perfect, but it's hard to get just from this single one analysis. And that's why I think this is a very nice example of why just doing one cycle analysis will often give you no final clue. As we've seen in this example here, should I now pick the one with the 174? Should I pick all 3? So should I just pick one out of these 3 cycles? They more or less give a similar picture. So the general outlook is topping this summer or early summer down into late summer. Yeah, so the general shape is always the same. That's good. But for fine-tuning, we need more clues which cycle to pick. And therefore, and that's what I always try to teach on this channel, is you need to be aware of the specific data set you are analyzing, about the rhythm. So, and that's the point. Has the cycle with the length of 274 shown up before, some months ago? Is it a valid cycle which helped us timing major tops and bottom in the past? Similar question to the cycle with the length of 180 something. Is this a cycle which showed up also in the past? Is it a trustworthy, valid cycle? This knowledge we can only get if we do this kind of analysis more or less day to day, week to week, month to month, to follow this asset class and learn which cycles from past analysis. So you could also call it a walk forward analysis, or you're automatically doing a walk forward analysis if you, from the historical point of view, you follow just your cycle analysis from week to week, and then you get a feeling about which cycle length would make sense to use. And then you derive your nominal cycles model. I mean, that's the same what Hurst was doing. Hurst was analyzing a lot of historical data sets to get a grip on what are the most important cycles. And that's where the nominal cycle model was coming from. And now, as we have digital signal processing, you should apply the same rules, the same way of working. Just use the banking index. Repeat this procedure just in the past with past data. Then you get a feeling about which cycles are often there, and then you derive your nominal cycles model for the regional banking index. And then, if this point shows up again, you would have known which cycles to pick. But let me guide you through. So now we move back in time on the banking index. Let's say, I think I've also loaded the chart here. This is the second example, now moving even further into the past. So I've now picked here, what's the date here? It's August 2022. So let's assume we also are analyzing this data set in August last year, yeah, to see what cycles have been active at that point in time, to get a clue what I said, to find a nominal cycles model for a specific asset class. I'm doing the same here. So again, using around 900 data points. Yeah, that's the basic starting point. So not a long-term analysis. Doing the same principles as you would have opened it in this data set in August 2022. Yeah, the dark blue data, so around 900 data points are used for the cycle scanner here at the bottom for the cycle analysis. I can even also hide the not used data points here. So in that case, we see this spectrum here at the bottom of the chart. So we have, again, 3 to maybe 4 peaks which are valid in the spectrum here. First, let's start with this one. It's not a perfect one. We have the 265 days. So it's not perfect from the shape of the spectrum. It's also not a perfect Bartle score, but it's kind of peak. So we need to take note of that. Second important, or even more important one, is the one with the length of 181 trading days. So very good Bartle score, a very good strength score, and a nice peak in the spectrum. So 181 looks like a very valid cycle length here in that spectrum. And we would use a third cycle with a length of 114. Again, good Bartels, good strength, nice visual shape in the spectrum. And if we want to use a fourth one, maybe the short one here, 66. So these are our clear rules to pick the cycles. Now we need to cross-check just to go from right to left the cycles here to pick. I mean, here we see that even though it's not a perfect fit in the spectrum, again, from the correlation test, just visually, it fits with past tops and bottoms. So this one here should be kept. Second cycle 181. You see here by just activating and deactivating, the overall shape does not change much in total. Yeah, you see a lot of these major points are still the same, but it at least smoothes out this longer term upswing cycle here. The other swings are still valid, but just fine tuning here. And then adding the third one with a length of 114, yeah, which gives us this situation here, and which is at that point of time giving us this projection here with the major top, and that's now the important point here, the major top to arrive at end of February 2023. So there are some takeaways from this chart here. So first, it's just moving into the past, and we now see at least 2 cycles show up here, which we had already from our past analysis. So the longer term cycle with 265. The previous one was 270 something. So we can find the first nominal cycle of around 270. The second one here is around 181. I think in the version before that was 182. So we also find a second nominal cycle length around 180. I think the other 2 have not been found there. So that's the first conclusion. I mean, it's not enough analysis, so I will do a third scenario just following up. But you see, I think you see the procedure that these 2 cycles, even though not knowing what happened, is the standard procedure. And we have now repeated this procedure 2 times with different points in time from the past, getting the same nominal cycle length here, which gives you a kind of clue what is the nominal cycle model for the regional banking index. And by the way, giving you more confidence that looking at a cycle length of 260, 270 seems to be valid. And second, if we now add the the data out of sample, we can see here that the forecast of this peak just from August last year just worked out to predict the top here in February, we're seeing. And again, the most important point here is also the generic outlook here is the same. So following this cycles model from last year, yeah, you see the same pattern from early this summer top into a low late summer 2023. So that's also interesting. Even though the exact tops and bottoms might slightly change, the generic outlook of this cycle composite is the same. So the cycle composite done in August 2022 compared with the cycle composite we did just some seconds ago with current data give you the same outlook. And at least two of these cycles are now showing up with the same reasoning to pick them from the spectrum. So now let's use a third point in time to do the same analysis. Oops, no, that's not what I wanted to do. So this example here, this is now more adding more data into the data set. And you know, I always recommend don't start with the historical analysis first. Use this kind of 3 times multiplied by the longest cycle. So if you want to detect cycles up to a length of 300 data points or days, use around 900 data points in your analysis. So that's more or less a good starting point if you want to have a valid projection line. If you want to look for what are good nominal length cycles with not taking into account the phase, then you can add more and more data points into your analysis. So that's why in that case, I'm using now, I think, up to 2,000 data points here in that example. Also starting here in September 2022 and just adding more data to see what is the cycle result using longer term data set, feeding into it using something out of the past to see what cycles show up in the spectrum here. And to see if this would also has helped us spotting the projection here based on cycles in this data set. So let's look at the spectrum. First cycle, which is showing up here, is a length of 184. And now I hope you get the sense here. So 180 is now showing up the third time. We are using a different point in time when we perform the cycle analysis. We use a different length of historical data points performing the analysis, and a nominal cycle of 180 is showing up in the spectrum. Yeah. So now you get a feeling that even though the cycle length, I think it was 181 or 182, showed up at the current point in time, but you now have confidence from using past cycle analysis models that this seems to be a nominal cycle, which is often valid in this asset class. Yeah? So 184 is a prominent cycle at this point in time here. Here we have now a cycle with 259 trading days. And by that way, these two cycles are very clean in the spectrum. They have green triangles, they have large triangles, and the shape in the spectrum is very nicely shaped to the left and to the right. So, and this is the 270 days. Again, third time. So I think it was 274, 260 something, and now 259. Yeah, 3 different cycles length, but now you can build a nominal cycle around 260, which was available in all 3 cycle analysis I did in this class. Yeah, so I hope you get the idea. Now we build a nominal cycles model for the regional banking index. For sure, at each point in time, the cycle lengths will vary around 160, a little bit shorter, a little bit longer, and for sure the phase will be different. So you need the cycle scanner to get the current phase. But at least you know better to pick which one to pick out of the spectrum and which not to pick based on the historical rhythm and specific cycles in that data set here. And the third one you could pick here is 389. And this is now valid to pick this one because you know that we have picked around 2,000 data points. Let's multiply 400 by 3. You need a minimum of 1,200 data points to really have a valid detection of this cycle. So as we have more than 1,200, we have now up to 2,000 data points, we could pick this cycle here also into the mix. So these are the 3 cycles to go with using this longer term forecast. And now let's pick these cycles. So that's the longest forecast here. And again, the light blue is out of sample, but what I'm mostly interested in, you see here the same pattern, just using the long-term cycle. A top forming here, in that case, late 2022, and then moving down into late summer 2023. Now you remember it's the same pattern we have seen on the other 2 cycle analysis. So now let's add the shorter term cycles into the mix here. Now adding the 260 normal cycle. What's interesting here, you see that the topping, the overall shape is only slightly changing. So the projection will really not change if you just select the longest one or just this one here. So it's just really just also interesting that the overall projection, what we are interested in, is not really changing. That's a good sign. And then adding the 184 in that case, which gives us this projection here. So, I mean, you see on your own that it nicely fits with past data. But even more important here, so this is the long-term analysis using more historical data, which is also showing us, and this is before the fact. No? I mean, this is where the analysis was done. This is how your projection would have looked performing this kind of cycle analysis in September last year, which would have shown us a peak end of 2022, and then a long-term downwards move into late summer this year. And the light blue data now shows us what has happened after the fact. So this forecast was done before this top occurred here. And you see now this sharp down move is more or less in the first section of this longer term downswing here. And this longer term downward projection, I think that was the purpose of the session here, all speak the same message. Doesn't matter if you use latest data, if you use data from, I think, August last year and just 900 data points, or if you move into September last year and use 2000 data points. First, you see more or less the same cycle length showing up. So we see some nominal cycles model forming in the regional banking index, which, by the way, gives us also a clue now if we update this analysis moving forward day by day. You can do this on your own now. Now you get better confidence now which cycles to pick if you do this on your own. And second, all these cycle analysis models projected us a top late 2022, early 2023, all speak the same language, and all point to the expected bottom in the banking index to come in late summer this year. So now you have also a cycle projection on the banking index. And last but not least, if you have followed the market models I updated here in our last sessions, you know that this cycle projection is also in alignment with the global market forecast cycles we did here, also expecting the major shift now in March with the negative cycle phase alignment into late summer. The same we see here on the the US regional banking index, which I just showed you here a second ago. So that's cycle analysis. So I don't want to just show you the current analysis. I wanted to use the current situation, the current market environment to learn something on cycle analysis. And I hope you take something away out of this analysis, how you build your nominal model specific related to asset classes, how you detect, how you identify when a cycle length seems to be a cluster, how you select different start and end points to go into the past, check your analysis to derive more confidence of cycles to pick. That's the purpose of today. Let me now take some time to check your questions. So just give me a second to open the chat area, and please feel free to drop in your questions. I just need to organize the window here. So I'm just checking your questions. And let me see. Okay. Now going through questions. Could you please briefly clarify whether should you use the full or the half cycle length for any indicator? Yeah, this is once you have the cycle length, and as you have learned for the banking index, there's the 270 and the 180, the nominal cycle of 270 trading days and 180 trading days. So that's what we learned from the cycle analysis. So these two lengths and an harmonic out of this length could now be used to fine-tune your technical indicators. And that's where this question relates to. The basic recommendation is use half of these two cycles through 270 divided by 2, 135, or 180 divided by 2 is then 90. So use 135 or 90, half of the cycle length, as an input parameter for whatever technical indicator you like. So it's not related to just one indicator. So using half or even a fourth, the most important thing is use an harmonic of that cycle length. And I think using the full cycle is not easy to read on a technical indicator chart. So therefore using half or even a quarter is better. So don't use the full cycle length. Elliot, that's hopefully helping this. Yeah, by the way, Dale, nice to see you. We had snow here in Hamburg over the weekend. So I think we had 10 centimeters of snow, yes, in Hamburg, Germany. And today we have sunny weather and the snow is gone. But seems to be similar in California. So just some greetings. But let me go through your question, William. Is it correct that we should always only be using a 5 trading day for all equities? Yeah, that's no. It's not only related. You just should be aware of what data set you have. If you just open charts from data which is provided, which is just providing Monday to Friday, so 5 days a week, 5 trading days, a calendar week data, then you talk about this trading day cycles. You could use full calendar days, but then you need to fill the gaps in your data set upfront, so you can adjust it in the settings parameter of the cycle scanner. So you need to configure that you want to have calendar days, and then missing days are pre-filled with previous close data, and then you have a full calendar day, even though it's just trading day data provided. Or you can leave it on the calendar day setting, but then you also need to inform the analysis algorithm that you use weekly data series, so skipping the weekends, to ensure that the projection and the analyst time frame are just synced. But it's not only. You could do both. And by the way, you could do an analysis on trading days like we did here right now. And then you could also perform a calendar day analysis, which will give you slightly different cycle length setting for sure. And then check if both analysis gives you the same projection area. So don't look for the same day, or for the same length. But if the cycle composite or the dominant cycle gives you the same results, then you have even more confirmation. If you get complete different results with using calendar days and pre-filling the weekends with past close, and this is not the same as you would get with trading days, then you should not use the cycle analysis result. You should not trust it. Okay. Hope at least, William, it gave you some direction. Yeah, I just excused for today. And I think in 2 or 3 weeks, we are back in sync again. So it's just maybe the next 2-3 weeks I need to ensure that the offset is taken into account. So excuse for this week. I think from next week on, we will be back at the general. Yeah, Donna. I mean, that's what the channel can be for here. So you named it. So we showed the cycles up front. Thanks, Donna, for bringing this back. Okay, Lars, is it better to evaluate all 3 possible cycles individually and then look for similar instead of a composite of the 3? Yeah, yes, for sure. That's the simple answer is yes, but it's not better. So it's a different way of looking of cycle bottom alignments and cycle top alignments, but that's what you're looking for, the similarities if the faces and the bottoms align. And just opening here one chart, you could just do this by only activating one cycle here from the mix and then comparing it to the, so this is the 180. Yeah, which gives you the top here and bottom here. So this is the down projection, and then you could also switch to using the it changed the 250, which is quite different. Yeah, so that's why, okay, in that case, yeah, that's why also the mix of composite and individual cycles, I think it's not, I can't argue that the one way or the other way is better, William. I would recommend do both. Check the individual cycles, and we use the cycles anyhow, not for price projections. I'm sure you're aware of that. So the cycles are just used to time the possible changes of the cycle phase, and we are not looking for the exact day of the change. You just want to be on the right phase, upward or downward of a cycle. So therefore, and this will add up in the composite the same way as you would see it in a single cycle. It's just a matter of, from a visual perspective, if you can see it more easily on these single cycles side by side or the composite. So I can't say that one is better or the other. Okay. Yeah, I know there are other asset classes like Bitcoin, like the commodities, like gold and silver, and I'm behind the schedule, but I think today was just important to talk about the banking sector. I mean, this session is also to review current activities, what's happening out there. Christian, can you show us how to have the system automatically collect the data day to day without having to upload it every time? Yeah, yes and no. So the easiest way is most of the daily data, which is available on Yahoo Finance, is available for you to pull up automatically in the platform without the need for you to upload. So you should first always check on Yahoo Finance if you find the symbol ID on Yahoo Finance. And if that's the case, you just simply put the ID on Yahoo Finance in the cycle scanner, like shown here. So I think the symbol for the S&P 500 on Yahoo Finance is this one here, which I'm just putting in here. And just add the following ID here, JFE, at the end, press enter, and this will pull up the latest data with today's data from Yahoo Finance. So that's the simplest way, Christian, at least to pull daily data, which should automatically be there. So we provide an easy way to get day-to-day data for most major indices, which are available via Yahoo Finance anyhow here. So that's the easiest way to check for daily data. I think I would leave it on that for today. I think the other questions in most cases rely to different asset classes and different topics, which I'm happy to pull up here. I think for today, I would call it the day. Let's check the temperature, the snow, the sun outside, wherever you are. Let's monitor what happens in the banking sector. I think I showed you a little bit what the cycles gave us here, how you read the spectrum. That's why we are here today. Other asset classes will follow next week. So please like, please subscribe, please tell your friends, please join me live next week, Monday, same place. I will be live. There is no business travel planned next week. And I hope I will sort out the daylight saving time changes. So I will work on it. Thank you for today. See you next week.